Hey, what's going on, guys? Welcome back to the channel all about real estate. My name is Lewis and I am super excited for today's video because this video is all about purchasing and accumulating a rental portfolio. But specifically, it's going to be for beginners, people who have a primary home that they currently live in today. They want to purchase a new home to live in and then convert their current house into a rental property. And if I could ask a quick favor before we get into the video, please consider liking and subscribing if you haven't done so already. Let's go. All right, so we're going to go ahead and jump right into it. There are two main things that I want to discuss with you here today. First and foremost, I'm going to go over the pros and cons of owning rental real estate. We're going to just touch on that briefly, but it's meant to help explain why somebody may want to use real estate as a wealth builder tool over the long haul. The second thing we're going to talk about is how you qualify to purchase a new home and retain your current or departing residence as a rental property. So we're going to break that into two categories. That'll be how you qualify as far as income is concerned, how an underwriter is going to view that income from the departing residence, and then we're going to look at the asset requirements there as well. So let's go ahead and jump into the pros and cons of owning rental real estate. First and foremost, I want to go ahead and talk about the benefits. Number one, you get to keep the long-term 30-year fixed rate debt. And right now, interest rates are hovering at all-time record lows, and the current government reported CPI is somewhere right around 6.8%. So if you can borrow and retain fixed rate debt at, let's say, 3%, and inflation is running at 6.8%, or even 4% or 5%, somewhere in that range, it's holding that debt and keeping that property is a fantastic hedge for inflation. The second benefit, of course, is cash flow from the rental income that you receive on that home. So let's say the property rents for $2,000 a month and you're able to generate $2,800 a month in rental income. After all of your expenses, let's say you net $300 a month in cash flow. That is $300 a month that you otherwise wouldn't have, that you can free up to put towards other investments or even apply it towards the principal balance to pay that home off sooner. Now, an additional benefit of cash flow or rental income is that the rents generally track inflation, which means the rental income for the asset should go up over time. And the beauty is the tenant is paying the rent to you on a monthly basis. So your tenant, in effect, is actually paying down the fixed rate debt that you hold on that property. And then the last benefit that I'm going to touch on briefly is that real estate is one of the most tax-favored asset classes available. Not only do you get the fixed rate debt that we already discussed, but you do get the benefit of something called depreciation. Now, there are nuances to depreciation and how that works, so talk to your CPA. But essentially, the IRS allows you to depreciate the structure of that property over the useful life. Now, the IRS considers the useful life 27.5 years. Let's just do a quick example and run these numbers on my calculator. Let's say you purchase the property for $500,000 and then the structure is worth half of that. So it's worth about $250,000. And we know that the useful life from the date of you purchase is 27.5 years. So you would divide that by 27.5, and it would give you about $9,000 a year in depreciation expense that you're actually able to deduct. What that means is, and again, this is a hypothetical scenario, but let's say you have $9,000 a year in positive cash flow on that property. Well, that depreciation expense will wipe that out entirely, making that effectively tax-free income. Now, again, there are nuances as to how this depreciation is applied. Talk to your accountant, talk to your CPA, make sure that you have the right information. Okay, now let's just touch briefly on some of the cons or negatives to owning rental real estate. So in this example, we're just using a single family home, which means that you will have one tenant. But what happens when you own property is that there are maintenance, there is repairs, there is management, and you have to deal with all of these things. You could get a bad tenant who maybe destroys the property, and when that property turns over and the tenant moves out, you may have to spend some money to fix it back up. And there may be a vacancy factor where maybe it takes you 2 or 3 weeks to fix up the property and then another month to rent it. So there are maintenance expenses, there are vacancy expenses, and then sometimes there's conflict resolution that you have to deal with regards to tenants. But I would say overall, a lot of these issues can be mitigated if you're purchasing a home in a really nice area, you hire a really good property manager who is screening these tenants properly, and then you keep a fully funded emergency fund to handle some of these expenses as they arise. Okay, so now that we've reviewed some of the pros and cons of owning rental real estate, let's get into the nitty-gritty and talk about how an underwriter is going to view your file. Specifically, we're going to review how an underwriter is going to take a look at the income from the departing residence, the home that you currently live in that you plan to turn into a rental, and then how they are going to qualify you based on assets alone. Because right now, when you go to apply for a mortgage, they're going to be looking at two loans, right? Because you're purchasing a new property to live in, and then you're going to be retaining your old home as a rental property. So you have two mortgages that you have to be able to debt service, but I'm going to show you how you can use rental income to help offset the mortgage on the departing residence. Okay, so let's run through an example. Let's say the home that you live in today, the one that you plan on turning into a rental, the market rent on that property is $2,800. We'll go ahead and plug that into our calculator here. And then let's say your current housing expense is $2,000 a month. Now they are going to look at your principal, interest, taxes, insurance, and any association dues. So let's say the property costs you about $2,000 a month. That gives you approximately $800 in cash flow. Now, will an underwriter view that $800 as additional income? The answer is no, they will not. There's a couple things that the underwriter does in this case. So if you take the gross rent of $2,800, an underwriter will actually only allow you to use 75% of that as qualifying income. So we multiply that by 0.75. That gives us $2,100 in potential qualifying income. So you may be asking yourself, well, why will the underwriter only allow us to use 75% of that qualifying gross rental income anyway? And the reason being is because they assume that 25% of the gross rents will go to things like vacancy losses, maintenance, repairs, and management. Now we know that the housing expense there is only $2,000 a month. That leaves $100 per month surplus. Is the underwriter going to allow you to use the extra $100 for qualifying income on the new property? The answer there is also no. And the reason being is because in this scenario, you're actually a first-time landlord. The maximum income the underwriter will actually allow you to use is just enough to cover the entire housing expense on the departing residence. So if your total payment, principal, interest, taxes, and insurance, and association dues is $2,000 a month, that is the maximum amount the underwriter will actually allow you to use. So in this particular scenario, you may have the ability to collect $2,800 a month in gross rent, but the underwriter will actually only allow you to utilize enough to cover your housing expense. But overall, that's a really good situation because in the underwriter's eyes, that essentially wipes out the mortgage expense and housing expense that you have on your departing residence, freeing up all of your other income, let's say from your job, to go towards purchasing the property that you're going to be buying to live in today. Now, one last thing to remember with regards to income, they don't just take you at your word on the market monthly rent. They will, in many cases, require a signed lease agreement plus the security deposit. Now, every lender is different. They have different overlays. Talk to your broker, talk to your mortgage professional, and get some guidance there. Okay, and the last thing that we're going to touch on is how an underwriter is going to view assets. In general, if you own 1 to 4 units in total, the underwriter is going to require that you show 2% of the aggregate unpaid principal balance between all of your properties. Let me go ahead and walk you through an example of what that may look like. Let's say on your departing residence, you owe about $400,000. And then let's say on the new property that you are purchasing, the loan amount is going to be $525,000. So the aggregate unpaid balance is $925,000. The reserve requirement will be approximately 2% of that balance. So if we multiply that by 2%, the underwriter will require you to show assets or reserves in excess of $18,500. Now, one thing that is really important here is that these reserves are in addition to the down payment and closing costs that you're going to be required to cover the funds to close on the new purchase that you're making. These assets can be cash accounts, checking, savings. It can be retirement, 401k, IRA. But just understand that certain accounts, like retirement accounts or brokerage accounts, the underwriter may only allow you to use 70% of those assets because they're not liquid cash. All right, so that is going to do it for today's video. We covered some of the pros and cons of owning rental real estate and why it is a good wealth building strategy over the long run. We covered some of the income requirements for the departing residents and how you can use that rental income to help you qualify, help you execute that strategy and start building your rental portfolio. And then we covered how an underwriter is going to view assets. So I hope you found this information useful. If you did, please consider sharing the video. And if you haven't done so already, please hit that like button and that subscribe button. We'll see you on the next video. Take care.